I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens. Pick and choose your own best-of-breed insurtech and data providers with the Sapiens Advantage Go ecosystem. Today's podcast is a masterclass with an expert in a class of business that has exploded with growth over the past decade. M&A insurance is a broad church that holds a large number of products that are all related to intercompany transactions. Representations and warranties, potential tax liabilities, litigation risk, and other contingencies related to M&A are the subject of this incredibly innovative segment of insurance. 3 decades ago, Alistair Lester was in on the ground floor as this class of business developed out of the D&O market. Today, this is a class that is producing $10 to $12 billion in annual revenue and can put out very meaningful maximum limits of around $1.5 billion for any one deal. But it's a class that most of us won't be familiar with, or perhaps one that some of us might think we won't be suited to, because we imagine it's full of people who first trained as lawyers and then got into insurance. Now Gallagher's CEO of private equity and M&A for Europe, the Middle East and Africa, Alistair has proved that this is a class where traditional insurance brokers can thrive. This is one of the most energetic and fun conversations I've had on the show for some time. Alistair's passion and enthusiasm are contagious, and through the course of this interview, I learnt an awful lot about this exciting class and its enormous commercial potential. We all know insurance is often a grudge purchase and always marked down as a cost. But here, it can be an investment that immediately pays for itself many times over. That's incredibly rare and perhaps explains why this class has so much opportunity and is giving cyber and renewables a run for their money for the title of highest growth segment of the global insurance market. Time with Alistair makes it clear that despite growing tenfold over the past decade, this maturing class has a huge amount of growth left in it. So listen on. If after 45 minutes you're not as enthusiastic as Alistair or I'd be enormously surprised. Enjoy the podcast. Alistair, welcome to the Voice of Insurance.
Mark, thank you. Great to be here.
I find this hard to believe, but if there's anyone out there who doesn't know you, why don't you introduce yourself to them? And, well, start by telling us how you got into the world of insurance.
There'll be a lot of people out there who don't know me, I'm sure of that. But how did I get into the world of insurance? Well, I am one of those very rare creatures who genuinely can say he chose the world of insurance as a career. How often do we hear, oh, I fell into it or it wasn't a choice? My father was a late career insurance broker, having been in the services, and joined the insurance industry as a broker. So I blame it entirely on him that I ended up in insurance. So I applied to many, many firms and was fortunate enough to be accepted as a grad at what became Aon a long, long time ago.
Which part was it that became Aon?
Bain Hogg.
Oh, right.
So
Excellent.
I joined Bain Hogg as a graduate trainee 10 weeks before Aon bought Bain Hogg.
Oh, excellent. No, I worked for a broker that had used the umbrella of Bain Hogg before it became a Lloyd's broker.
There we are, small world.
And when was that?
So I think it would be 30 years ago. So 30 years, 1996. So that was when Aon bought Bain Hogg. So I joined Aon in 1996. I was lucky enough to have a bit of a broad experience across the business as a grad trainee. And then I fell into, fairly quickly, what was the very nascent M&A business in Europe.
It must have been really nascent.
Very nascent. So It was, in those days, Aon was a big investor through its insurance company balance sheets in some large US private equity funds. And as they started to invest in Europe, they thought they needed some help answering some insurance questions. And who should they ask? All those lovely people at Aon who invested in us. And somehow M&A inquiries started to make their way to my desk, and seeing the first sale purchase agreement I ever read terrified the life out of me. And somehow I'm still looking at them today.
But you didn't come from a legal angle.
Absolutely not come from a legal angle. And I think I'll get the message across about that, I think, a little bit as we get into the conversation, because I think this is a part of our industry now which is so heavily populated by ex-lawyers, which is fabulous, and they bring a huge amount to our industry. But actually, not being a legal brain, I think, has been helpful.
You just need some good old-fashioned broker there. So what was the origin? Where did it spin out of? Often it's a thing that, you know, maybe the people who are doing D&O or the financial institutions team get asked these things first. Is that where it was sort of professional indemnity teams got asked, can you do this? Or was it contingency
teams? That's a great
teams?
question. So actually, the role of insurance brokers in the M&A world was predated the boom in M&A specific insurance products. So the questions originally were, we're buying this business and we need to understand and make sure that the insurance programs in place for this business are appropriate and adequate for bank financing particularly. So insurance due diligence was probably the first activity that really got embraced by the private equity community. And out of that came questions, again, as often is the case in our industry, the innovation doesn't come from our side of the table as it comes from the client side of the table. And as we got into deals and started to be present in more deals, more lawyers or clients started to say, can we insure this or can we insure that? And that was sort of the birth of W&I, or as we call it in the US.
And what were those
Warranties.
first underwriters? Were they D&O underwriters?
They were typically D&O. So typically the brokers who were doing this in the early days were D&O brokers, and the underwriters were D&O underwriters.
I suppose if something's just, for example, a contingent tax liability, there is a contingency market. But then I suppose they're more used to doing hole-in-one.
Exactly. The technical experience wasn't there for tax insurance.
No. They'd know about whether, this particular rock band was likely to turn up, whether they turn up or
exactly
not.
Right.
But also, or, whether this actor was about to die while on set or not. But yeah.
But that's also a wonderful example, I think, of the way that we define. We have insurance industry definitions for things and classes of risk that aren't necessarily the same definitions that might be used in the outside world.
I mean, contingency just means insurance, doesn't it? Because insurance is there for things that might, so
might
fire
happen.
insurance is
might
a
not,
contingency.
but might. Yeah.
So it is the most broad and non-specific class of insurance, isn't it? Which is a fairly good definition of what it is.
Spot on. So I spent a lot of time doing insurance DD. I was then around in the early days of M&A, specific insurance starting to become a little more active and mainstream. But I then, and I won't name names, I then got told by my senior leadership at the firm I was at the time that M&A and private equity are only going to be a niche part of the insurance world. And if I wanted to progress my career, I needed to go and do other things. I'd moved to Willis by this time. I went and did a whole load of things for Willis I was singularly unqualified for. I was then fortunate to be persuaded to go back to Aon some years later. This M&A thing, we really think actually it's core, not niche. And that obviously appealed to me because once you've been in the M&A private equity world, it does get in your bloodstream and you enjoy the dynamics of it. And I returned to Aon and we had a great time building a business at Aon, which grew very rapidly in this area. And I am now super excited to be at Gallagher, which gives me a whole new challenge of building what I think will be version 3.0 of the value prop for our industry in the space.
Knowing the nature of our industry, a lot of people listening will be interested. They're listening because they don't know anything about M&A insurance, but they know it's been quite an exciting area, particularly the last decade where it's grown a lot. So can you give them the sort of version that you give your other colleagues who are working in other classes, who are in different insurance silos, and they say, what's this all about?
Most other professional services or financial services firms, the M&A business of those firms is absolutely at the center of their strategy. It's one of their key organic drivers. If you're a lawyer, you're an accountant, you're a banker, if you're an M&A person in those firms.
I don't know. I mean, we are sitting in Gallagher's offices as well. So let's say it's a very important part of the Gallagher group.
Corporately, it's an incredibly important part of Gallagher group.
Yeah.
I mean, Gallagher's completed, 500 acquisitions in the last 15 years?
Another.
And it's a strategic differentiator for this firm for sure. But that's us as a corporate acquirer rather than us as an advisor to those deals. So the insurance industry's role in advising in M&A has always been relatively less well established than other peer professional financial services firms. And every day, I would tell you, every day of the year in the UK, a number of Gallagher clients will be going through some sort of M&A process. They'll either be buying something or they'll be selling something or they'll be refinancing or they'll be demerging something, whatever it might be. And very often in the past, the people at those clients who are doing those deals wouldn't necessarily think of including people in our world in that process. They might phone us at 4:30 on a Friday afternoon and say, by the way, I've just bought this business. Can you make sure that the insurances are okay for when we buy it? But they don't proactively involve us in that process. And yet there is so much that we deliver into those clients and can deliver into those deals, which add value to those situations. So really raising awareness for our colleagues and then for our clients about what that is really a fantastic opportunity. And I use a phrase, M&A is a situation, not a solution. So I don't want, when a client says, well, how can you help us in an M&A situation? The answer is, well, we can sell you this product or that product. There's a range of ways we can help you. We can help you in an advisory capacity. We can help you in an insights capacity. We can help you in a corporate insurance capacity. We can help you in employee benefits insurance capacity. And yes, there are a suite of specific insurance instruments which can be deployed to enable and facilitate M&A deals. And let's talk about those as well. Yeah.
Whilst we're not product salesmen, what are the main products though?
So the main specific products, if you get very specific about it, the core is warranty and indemnity insurance, known in the US as representations and warranties insurance. The second most commonly known product, which is growing incredibly fast, is tax insurance. But W&I insurance has been increasingly mainstream for the last 10 to 15 years.
Obviously, we know warranties are always a terrifying word to see in an insurance context, aren't they? As we know, if an underwriter is warranting something, you think, oh goodness, I wish he could temper that language and make it sort of, make it a condition rather than a warranty. So these are the promises that people are making to each other when they're buying and selling. They're saying, look, it's definitely going to be this. And if not, well, you can come after me. And here, this is where the insurance will kick in. You're guaranteeing something, effectively saying, look, I think it's going to be this much and it's not that much, or it ends up being loads more, then the insurance is there to cover it.
Exactly right, Mark. So look, the traditional way of doing M&A, if I was to buy a business from you, is you disclose a lot of information to me about your business. I would undertake a lot of due diligence on that information and on your business. You would then make a whole load of promises, warranties in a sale purchase agreement about your representations, about the information you've given me, about the state of the business. And traditionally, before W&I insurance was around, I would then agree and negotiate with you that if one of those warranties proved to be wrong after I bought the business, if I suffered a loss because of something that you had either failed to disclose or wasn't true in one of your promises, I would be able to bring a claim against you.
Yeah.
And if I was buying your business for £100, I'm sure the voice of insurance is worth an awful lot more than £100. But if I was buying your business for £100, traditionally I would have said in that agreement, and you would have accepted it, I have the ability for a number of years after we've done this deal to bring a claim against you for up to, let's say, 10% or 20% of the £100.
And I suppose depending on which jurisdiction you're in, there's going to be a statutory limitation on how long you've got.
All of those, particularly on known issues like tax or other issues. And of course, what you want to do with your £100 is take as much of it as possible and go and live on a boat on a beach.
Yeah, because otherwise I have to keep £6 in a rainy day account just in case for the next 6 years.
Well, that exposure runs off. Right? So the traditional way of doing deals was always fundamentally unattractive when you think about it in that context to people selling businesses. And what insurance has done is it enabled buyers to get the security and the recourse that they need and sellers to get the recourse-free exit and take maximum day one unencumbered sale proceeds out of a business.
I totally get it. And of course, the insurance can do it in a more efficient way because they don't have to hold all that capital for all of those things because they've got a spread, diversified book of business, of course, and they can be solvent, and that's fine. Absolutely. And that's where the fundamental value is unlocked. This is just a more efficient way of people doing M&A deals. If they buy the insurance, it can work, whereas it might look like some kind of magic arbitrage. It's not, actually.
It's not. I mean, no one buys a business wanting to bring a warranty claim against the seller. They buy a business because they want to make that business successful, but there remains that risk of claims situations manifesting themselves, and insurance is a wonderful, and I've often called it the purest type of insurance. It genuinely enables commercial transactions to happen in a way which is more attractive for the various parties than otherwise they would happen. And I think what's particularly interesting is the boom in this product was accelerated post-financial crisis, which coincided with a real growth in the activity levels of private equity funds selling businesses. And private equity funds are even more sensitive to having any post-sale recourse exposure than other people.
And of course, often they're set up, they want to be in and out and they don't want to have these loose ends.
You know, their motivation is to generate maximum day one unencumbered proceeds so they can distribute their funds back to their investors.
And they might have a fund that needs to close.
They might have that.
Yeah.
The longer they are not giving money back to their investors, potentially the greater the sort of reduction in the return profile they're giving to those investors. So spending money on an insurance instrument in an M&A deal can accelerate the funds being returned to investors, which can enhance the overall returns.
What about going back to the tax thing? So give us an example of the tax product.
So what's interesting about W&I insurance, it is there to protect against the unknowns arising in a deal. Often, however, in a transaction, there will be known issues identified, either because you'll tell me they're there and if I'm buying voice insurance, or because I'll identify them in my due diligence. Tax is often the best example we give of known issues identified in deals. You may perhaps have done some enormously complex but entirely legal tax structuring in voice of insurance, and I might not like that because I wasn't part of the advice. I'm not casting any aspersions on you, Mark, whatsoever.
Isn't everything a Dublin subsidiary of a Guernsey holding company which is owned by something in Mauritius?
Tax codes in every country are highly complex, right? And tax advisors are there to give advice on compliance or otherwise with the tax codes, to optimize their client's tax position, but no tax advisor in the world will ever guarantee the advice they're given is correct. You have to make an informed decision on the risk that you're willing to take from a, in this case, tax perspective. And what is amazing about the tax insurance business is it bridges that uncertainty to certainty, and the cost of that bridge is the premium.
Yeah.
And this has, again, been increasingly utilized over the years as clients have understood this as a tool. It's a fantastic bridge between particularly people buying from very sophisticated, very heavily advised private equity firms who do a lot of tax structuring in their businesses. But if I'm a more conservative strategic acquirer of a business, I might not be quite as comfortable with the tax liabilities that I'm assuming in this business. And again, traditionally, how would I deal with that? I'd say to the company or the sellers of the company I want to buy, look, I love this business. I'm going to pay you $100 for it, but I can't pay for that tax liability today. So I'm going to pay you only 80. So I'm going to price chip you. Or they say, I've got uncertainty. I'm just not comfortable with that tax issue. So I need you to put $20 in escrow for 7 years to see if that tax liability crystallizes. Or they might have said, that $20 of tax liability, I tell you what, I'll give you $100 for the company, but I'll pay you 80 now and I'll defer $20 until such time as we're comfortable whether that tax risk goes away or not. Again, none of those are attractive to a seller because the seller wants their 100. And the wonderful thing about insurance is we can potentially solve that tax liability risk of 20 for a fraction of that amount, a single digit percentage of that amount. So a seller gets maybe £99, the insurance market gets £1 or $1, and the client seller gets maximum day one unencumbered proceeds, and the buyer gets the security they need.
That's a really good return on your £1 investment. You get £19 back.
And again, which is why I love this industry, because this is a part of insurance where in a number of situations, you can absolutely clearly show to a client that by investing in an insurance product, an insurance solution, insurance instrument, there is a direct return, directly correlated return. And so much of our industry is about what's the value of what I'm buying. And the value often doesn't manifest itself in insurance until there's a claim. And people don't want to have claims. It's a negative thought. This is, we are unlocking risk. We are providing certainty on a risk situation, which otherwise will distract us from doing a deal. And it's allowing us not to focus on the tax issue in this deal, but focus on the business I want to buy.
Yeah.
And I know I can deal with that tax issue because insurance can take that off the table.
Yeah, we can do the fundamental stuff that we really know about this industry and not have to worry about all the other stuff. So are sellers the main buyers of the product? I mean, if people are about to sell a company, because if you've sort of prepackaged this, so you could have almost prepackaged all your due diligence, you can say, I know I can make my, instead of 100, it's worth 120 now because I've bought the insurance. It sounds like they've got the more incentive to buy the product.
It's a great question. So if you go back right to the genesis of the products, actually the insureds were the sellers. So originally, warranty and indemnity insurance was a seller's insurance.
Yeah.
Now, what did that mean? That meant, again, if you bought the insurance because I'm buying your business, I would have to bring a claim against the SPA, the sale purchase agreement, and you would then involve insurers in defending that claim.
Yeah.
The evolution came to the point where we moved to buyers taking out the insurance.
Right.
So most of the insurances around today are buy-side insurances. But here's the nuance. An increasing amount of them are catalyzed by sellers. So you'll see in a lot of deal processes what we call staple processes, so staple products. So sellers will pre-package the business they're looking to sell with a lot of due diligence. And by the way, if you're concerned about this tax risk or if you're concerned about general warranty recourse, we have pre-packaged an insurance policy that at some stage, at the right stage in the deal negotiations, we will pass to you to finalize for your own account. There is an analogy in finance, which is staple finance. So for years, sellers used to get banks to provide a bank financing package for the buyer to take on in a deal. That's what we're doing. We're basically pre-packaging an insurance solution, which means, again, the buyers and sellers focus on the fundamental of the deal, not on these liability allocation negotiations. And then the buyers pick up that negotiation and finalize it on the buy side for their own account.
How big is the market? Let's say it's evolved over the last 25 years. In terms of GWP at a global level, what do you think?
So I think it's about 10 to 12 billion a year dollars now.
So it's getting pretty chunky.
It's getting pretty chunky.
It's up there with cyber almost, not far off.
I think probably is, yeah. I
mean,
listen,
cyber's sort of 15,
the difference
16.
is you've got a renewal book in cyber, and this is new each year. This is one-off risk stuff.
Yeah.
I think it's at best 10 to 15% of market penetration on the W&I side, particularly because this has mainly been a middle market and upper middle market and larger deal
Because
solution.
I presume there's a kind of ticket size, there's a kind of get out of bed cost for getting all this infrastructure and well-paid people out of bed.
Today, that's absolutely true.
Is that coming down?
It is. So there's been an increasing amount of competition in the market, a lot of new capital coming into the market. It's a very heavily MGA-dominated space.
Yeah.
So there is an increasing amount of competition in the market. That's driven both rate and also attachment points and segment appetite in the smaller deal space. I think we are on the verge of seeing how the small deal space gets unlocked through a really smart use of technology and AI.
Yes.
But that is almost the next horizon opportunity for us in that class.
What percentage of deals that are within scope or are buying insurance right now?
So on the W&I side, look, about 10 to 15% of deals globally buy it. But then
That's
if you
pretty
think
good.
about...
That's pretty good. And what was it, say, 10 years ago?
1 to 2%.
So that's massive growth.
Massive growth. But the challenge now is probably 75 to 80% of deals that happen around the world are sub 10 million of enterprise value, of deal value.
Right.
And that has not been where this market has been focused.
Do you think it's going to be the MGAs? Often it's the MGAs that bring the new tech, because they're more nimble. And obviously they always want to bring distribution. So do you think they're going to be the ones to unlock it?
I think you always see the MGAs trying to be the first movers. So yes, that said, I think there are also plenty of direct carriers, big, well-known direct carriers who have tech capabilities they deploy in other classes, which they could look to deploy in this class. So we'll see where that pans out. And of course, right to say, you'd expect us as brokers also to be looking to control the tech platforms and the distribution platforms that we can offer to clients. And the analogy I draw, Mark, is D&O. If you go back, I don't know how many years, a few decades at least, when D&O first came, it was a highly complex, highly manuscripted, large risk solution. Now you can probably go on dnoinsurance.co.uk and a few clicks and a couple of questions and buy it online, right? You can see that that is a path that this class can also go down.
What's the biggest limit the market could put out on a single risk? It sounds like there is more market than there was. When your brokers are walking around, you've got your crib sheet of what's everyone's maximum line. If you aggregated all of those and you somehow got them all to agree to write this one, say it was Apple was about to take over Tesla.
You heard it here first.
No, it's never going to happen, by the way. And someone says, right, Alistair, what's the biggest limit we could possibly put together?
Yeah, look, I think it's probably in the range of about $1.5 billion.
So again,
it's chunky,
sensible.
but again, you think about that in the context of most clients will want, on W&I that is, most clients will want to buy 10% of enterprise value, maybe 5%, but you're maxing out at sort of the 50. So these are big deals, 15 to 20 billion. I know that the largest insured deal has just been done in the market was a 30 billion euro transaction. I don't know how much was insured, but let's say it was 1.5 billion.
And I suppose, but those sort of things, I presume the self-insured retention element of that would be quite large and you could be writing quite high excess.
So you've led into an interesting conversation that you wouldn't often get into if we had a lot of M&A lawyers around the table. Because the point here is the product has started to be deployed in a pretty homogeneous way. You need to attach this at the lowest possible attachment point from ground up or first dollar up if you can and get as much insurance as you can.
Deductible, yeah.
But you don't need to do that.
Yeah.
If I'm a buyer and I've got a certain risk appetite or even a materiality threshold in my deals, if I'm doing a 100 billion deal and I think I can only get 1.5 billion of insurance, why would that be for the first 1.5 billion of risk? Why would I not potentially sit that above my 2.5 billion of material, whatever my materiality
what's
is?
material to you?
So I think this is where this idea that there's some insurance nous that we need to start deploying alongside of the very smart legal
and this is where the
nous.
broker comes in, yeah.
And this is where the broker comes in.
Yes,
right?
you can start to structure these things.
You can start to structure these things. And I think there's a huge amount of product development that will come from looking left and right at what other classes of insurance have done over the years and starting to build capacity models and solutions in a way. I draw a lot of comparisons, not only with D&O, but also the construction space. You think about how the construction insurance market evolved from being single projects to being owner controlled or whatever it is, all of those sort of shared limits, shared exposure policies that are out there, that can be done in this space. And we've got a long way to get people to understand that can be done in this space.
So again, is it that bankability? So is it banks? Often in many classes, it's the bank ultimately that's kind of pushing this. If there's finance behind or there's private equity firms that are behind this, are they the ones saying, right, you must buy the insurance, otherwise I'm not going to get involved?
So if you go back to the origins, as I said, of our industry's role in M&A, insurance due diligence was absolutely catalyzed by banks requiring to see a professional advisor's view of the insurance arrangements of a company. It was a conditioned precedent of the lending that there was a insurance due diligence done by a professional insurance advisor. So in that context, absolutely. Occasionally, you will see banks identifying known risk that they're uncomfortable with. What the banks want is they want as de-risked a lending opportunity as possible. And if there's a risk that there is a large contingent tax risk in a deal that could have a large cash flow impact on the company, if you can de-risk that, then it makes their lending easier. Banks also, of course, have their own risk appetite. They have their own cost of capital models. They have their own ways of pricing risk in the terms and tenor of the financing that they put out in the deals. And if we can, I think this is a fascinating opportunity, if we can start to bridge a gap to solve problems between lenders and borrowers more effectively, then I think we'll see banks get even closer to the decision-making process. So we think there's an opportunity to spend time with banks to show them how they can differentiate themselves in a competitive market, because the banks are all competing to lend. The banks all want to lend into deals. And if we can show them how their terms and tenor can be half a turn more attractive than someone else's because they're using an insurance product to solve for a risk that's in the deal, and they're showing the borrower how that will help, then we think there's an opportunity to do that.
Again, so you can get a better interest rate.
Better interest rate, longer tenor, maybe on the debt.
Right.
So look, there is a deeply interwoven relationship between banks and finance. We don't think there's been enough of a light shone on that.
Yeah.
We think that's changing.
And because it's not a renewal class where, of course, every single one of these things is an individually a bespoke deal that is by definition ever going to happen again. So you can't renew it. Do you get that kind of more renewal business out of those relationships with those people who've bought from you before, who had a good experience and then want to buy from you again?
So look, on the specific M&A and transaction insurance side of things, absolutely. Again, I draw the analogy with construction. If you're a contractor, then you either have an owner control program or you insure on a project by project basis. Same goes for this. What I think we've found over the years, Mark, is those clients who have used these products for the first time then understand the value they bring. And whilst they are categorically not a panacea to every risk situation in a deal, they will be putting them in their toolbox that they'll look to deploy in similar situations in the future.
And do you think we can end up with a situation where someone who's a serial acquirer, for example, a bit like a Gallagher, actually, in that sense, you've got a lot of transactions, particularly similar sized, regular, this is part of what you do. Do you think you could offer them an annual policy where they've got sort of different declarations on it?
Well, look, I don't want to give away our differentiated IP on what we may be working on at Gallagher, but I think you've touched on something really interesting.
Sense.
Yes.
Only if it makes sense.
The short answer is 100% correct, right? So if I am a serial acquirer and I'm buying individual tower limits on a per deal basis, but I have a very consistent approach to my due diligence, to a very consistent playbook for how I do M&A deals, why couldn't you be sharing exposure across an aggregate limit on an annual basis or on a shared excess basis or whatever it might be? So again, as people become more regular users of the product, there is that broker now, which is, well, okay, how do you then optimize access to the capacity for those users?
I'm going to make up a product for you. You can tell me why you can't do it. You mentioned about the tax liabilities. And as you say, those designers of innovative tax structures won't give you a guarantee. Do you think you could give them a product guarantee from the insurance industry? So again, you can say, yeah, there's always material uncertainty about whether this is going to be acceptable to HMRC or IRS, etc. But we've got a guarantee.
Look, there's a line there between E&O risk and the solution you're talking about. I think where I would go with it is I was sitting with and look, again, I'm not a tax person, but all our tax brokers are ex-Big Four tax advisors. And I was sitting with the head of tax at a very large corporate recently who had never heard of tax insurance. And he said, look, you see that individual in the office over there? That's the head of our real estate and real assets portfolio in this business. He looks after the assets and liabilities and billions of dollars of assets for this business. And one of the tools he talks about when we talk about our relative jobs is how he uses insurance to help manage the assets and liabilities. He said, I look after billions of dollars of tax assets and liabilities for this company. No one has ever sat in this room and talked about how insurance could be one risk management tool I can deploy. So I think the tax insurance space has got a huge amount of way to go because it's not just using tax insurance in a transactional M&A context. It's got the potential to become a corporate risk management tool for annual tax assets and liability management. And I think if you get there, then again, broker speaking, the analogies between how you can bring capacity to bear and how you structure capacity in an annual basis or whatever else. I have tax assets and liabilities on a portfolio basis. I have property on a portfolio basis. I have general liability on a portfolio basis. And guess what? Our industry is able to provide package solutions to that.
Look after them.
And I've got to think that this is where that will go in our world.
That's really, really interesting. But you don't think maybe if it's 2050, we'll be sitting here sophisticated enough to give a tax advisor product guarantee on some of their structures? If I'm still here in 2050 and I've done something very wrong in my life, I'll be delighted to still be going into 2050. Who knows? I think the answer is who knows. There have been forays into this space by at least one of the Big Four looking to become brokers. They stepped away from it. But I think that would suggest that there is a thought process going on inside some of the big tax advisors that they understand the application opportunity for insurance in their world. Where that leads to, I don't. And what about, of course, the demand, the fundamental demand is how much M&A is happening. Isn't that also quite cyclical? Well, certainly within individual industries, we know within insurance industry, we know that there's a cycle because it correlates with the pricing cycle. In the aggregate, Do we end up with a similar number of deals, or are there economic variances? Are there times in the economy, in the global economy, when there just happens to be more in M&A in terms of when there's a bit of a famine?
The short answer is yes, it's cyclical. You never hear a negative M&A person talk about slow markets.
But anyone who works in M&A knows that there's always a feast and there's always a famine.
There is, but the feast is always longer and bigger than the famine is, or has always been in the past. But look, you can look within a band and it fluctuates between X tens of thousands and Y tens of thousands over a multi-decade basis. We had an absolute feast in 2021, which was probably the real peak of the market. And there have been a number of macro, geopolitical, economic dynamics which have caused slower M&A markets in the last 2 or 3 years. Interestingly, the large mega deal space remains pretty healthy. The small deals are reasonably healthy. The mid-market is a little bit stuck. And there's quite a backlog of businesses that need to get sold because a lot of those businesses are private equity owned and they've got to be making exits to generate returns. And an old advisor I know quite well used to say, we're in a logjam. We need a little bit of stability. What deal doers need is predictability. They need to be able to build financial models. And in today's world, is oil going to be at $80 a barrel, $150 a barrel? How do I build that into my financial model? And that just means people step back a bit from doing deals.
But there's more uncertainty. Ultimately, it's good for insurance.
I think as long as deals are happening, uncertainty is good for insurance. And I would absolutely say that there was a fundamental change in deal doers' risk appetite post-global financial crisis, which if you really trace back the acceleration of these classes of business came from that.
What about the market itself? I've been reporting on this market for the last 10 years. It's been fantastic, great growth. Certainly anecdotally, 10 years ago, everyone was very happy. People had discovered this class and thought, goodness me, this is great. I kind of want to get a piece of this action because I think some very nice, low, almost single-digit loss ratios that people were eyeing and saying, wow, I want some of that. And then there has been a great boom, but also we've had, tenfold increase in demand anyway, and penetration, which is fantastic. What's the market like at the moment? Because yes, often it happens when you have a new class and people say, great, this is a new line, this is a new P&L to add to my others and I can diversify.
Yeah.
It doesn't correlate with all the others. I don't need a whole ton of extra new capital to write this business. Again, that can be a bit of a feeding frenzy. Well, I don't want to put words in the mouth, but it's been a very competitive market. So where are we now?
So it remains a hyper-competitive market. I have said before, and I'll say again, we have an obligation. Look, as brokers, it's our job to get the best possible deal for our clients in the market. At the same time, the community has a collective obligation to make sure that this is a sustainable market. As I said earlier, people used to do M&A deals without using insurance. If the insurance industry is not sustainable and can be there for the long term, people can go back to doing M&A deals without using insurance. So we have a collective obligation to make sure that this is a product that works for the people doing their deals, that is priced in a sustainable way, and is there in 2050 still as a core part or even a bigger core part of the M&A market than it is today. There have been an increasing notifications for sure, but then that goes with an increase in penetration. We have notification provisions on policies that you have to notify circumstances that may give rise to loss, and therefore, guess what? Notification provisions are adhered to. And there has been an increase in paid losses. And paid losses are really important, obviously, because again, if we ever find ourselves in a situation where clients and advisors, because the advisors, the lawyers and the bankers are critical stakeholders here, where clients and advisors believe that they have a valid claim that has either become too difficult or has been declined for reasons they don't agree with, they will do their next deal without using insurance. So it is in our interest to demonstrate the value of the class.
Yeah, and what's the experience on the claims side? Because when something's a new product, the first claims, they're always going to be navigating and they're always fall in an area that is not necessarily that clearly defined. And we all know. So how's the experience been?
So look, there are different views. The notification rate is probably somewhere between 20 to 30% across the portfolio. Claims settlements, where there's actually a payment in terms of volumes rather than in terms of loss ratio, is probably in the 10% range, 5 to 10% range. So the statistics will show you that most of the claims settled remain relatively modest. So single digit millions of claims, even on larger deals. They tend to be broadly dominated by financial statements. So some misrepresentation or disagreement in the financial statements of the target company. But there are also, and there have been, some large notifications out there. Again, in core W&I, there was not long ago a large $1 billion notification in the US that settled out at about 300 million on a deal. So look, there are larger claims out there. The claims severity is probably more felt in the known risk categories. So tax insurance and litigation risk insurance as two good examples, where typically these are more, not always, but more binary. Either tax is due or it's not. And if it's due, the claim's due. The claim has to be settled.
And there's no real mitigation there, is there?
There's always chances to negotiate and have a commercial conversation. And some of those limits have been very big. So well reported in recent times that some large litigation policies had large claims on them. And what's happened there is, again, the reaction of our market is to be in danger of throwing the baby out with the bathwater. Not all litigation risk is the same. So understand what the differences are between different types of litigation policies and different litigation risk. Just because a litigation case has gone bad and there's a large claim, don't let that leak in and cast a shadow over other known risk policies like tax. And moreover, don't let that leak even further into the core W&I market. And there has been a tendency, both in terms of the way we talk about this market, in terms of the way it's reported on, that everyone throws all of these classes in the transaction liability bucket, and that creates a knee-jerk reaction in the capacity chain, MGAs to carriers to reinsurers, who don't really understand the specific nuances about what products and what situations and what jurisdictions are causing loss.
And that's your job as brokers, really, to kind of bang people's heads together sometimes
Exactly right.
and say,
Tell the story. Yeah.
Don't throw the baby out with the bathwater because this is a good product,
Exactly
fundamentally.
right.
And what sort of tail are we talking about when there is a claim?
The policy period for W&I is 1 to 2 years post-signing. Tax exposure tends to be statute of limitations, so 7 years. So you have a reasonable tail on this business.
These are claims-made policies, I'm presuming.
Policies,
Yeah.
So, and you also have an interesting phenomenon, which is, for the most part, warranty claims, because they're largely related to financial statements, as I said, they will typically start to manifest notifications a year after you've gone through the first audit process as a new owner of a company. So you'll very, very rarely see claims notified in the early stages post a deal. It tends to be in the 1 to 2 years after a deal. So look, there is the tail, and we're finding out, and more notifications we have, with the more sort of insight we get on how long that claims process plays out.
Obviously, it could be 4 or 5 years.
Could well be 4 or 5 years.
And of course, even if there's a disputed claim, one presumes it's going to be even more.
It can be.
Because, of course, there aren't that many really good tax judges out there.
Well, that's a good point.
I mean, they're busy, aren't they? They're very busy.
The other side of this, and I should have said it earlier perhaps, these, I believe, are some of the most heavily advised policies in the market. At the end of the day, these are policies that, when they're put in place in a transactional context, they're put in place where the sellers have got their lawyers, the buyers have got their lawyers, the brokers are all ex-lawyers, as I've said, the underwriters are all ex-lawyers. So these are some of the most heavily advised and legally reviewed policies in the market, which I do think should stand them in good stead to go through a claims process as and when they're required to go through a claims process.
So at the moment, would you say the market's very competitive, softish?
I'd say softish is an understatement. I think extremely soft. So we continue to see new capacity coming into the market. We have seen some capacity come away from the market, largely because of return challenges, but we see new capacity coming into the market. We see MGAs. I think the real challenge is I don't see enough differentiation, either in the broking or in the underwriting space.
So someone comes and tells a really good story and say, yeah, I'm going to really reduce that ticket size. I'm bringing in new business into this market. Then that makes a ton of sense. But if they're going to be competing on the same deals that everyone else is already doing.
I would love the market, brokers and carriers, I'd love the market to be able to articulate where they're differentiated better than they do. And when new capacity comes to the market, I have experienced conversations with new capacity coming to the market where you say, please tell me what your differentiated strategy is. And they just say, we want a piece of this market. That is not a sustainable strategy. So I hope we start to see some bifurcation in sector, in deal size, in jurisdiction, which people really start to say, our sweet spot is we focus on these sectors and these geographies and these deal sizes, and we've built a product bespoke to that area, rather than we've just got to write premium and we're going to compete with everyone else in the core market.
So you've got the core products of warranty and indemnity, and you've got tax liabilities. Are there any other new elements that you're going to be able to bring into this? Because obviously there's all sorts of risk. I mean, we've got climate risk, we've got regulatory risks. I saw something on the slide on a presentation that you'd made recently about employee benefits. It was really interesting. Other things that you wouldn't necessarily think about. Any of those going to become another new strand of business that you're particularly excited about?
So as I said earlier, yes. And as I said earlier, look, an awful lot of the innovation in our world comes from the client and advisor side of the table. So we encourage clients to think about the I wonder if question when they're in a deal. I wonder if this is insurable. And what you get out of that is you get a lot of bonkers questions from clients, but you get the ability to say to clients whether something is absolutely insurable because it's something we've done before. It's not something we've done before, but we believe the fact pattern is insurable, or it's categorically not an insurable risk, and they're going to have to find another way to solve for it in the deal. So we have this amazing innovation catalyst with these clients and these deals. If I come back to the comment I made earlier about we're seeing this big opportunity in the lender-borrower space, we're also very good in the insurance industry, and I'm guilty of it myself. We do something once and we then celebrate it and talk about it for 5 years rather than industrializing it. Whereas the investment banks, if they build an instrument, using that wonderful financial phrase, they build a new insurance instrument, they then industrially identify where that instrument can be deployed, and they have a campaign to educate potential buyers of that instrument in an organized way. We do something once, we do a case study, we shout about it, we still talk about it, 5 years later about, do you remember when we did that really funky structure? And we don't industrialize it. So I think there are a whole load of individual examples that have already been done we can look back at and think about how do we industrialize it. We are very close to bringing on board, in fact, she starts next month, a lady who has been working in the private credit space and most recently HSBC. She is not an insurance person. She's a private credit banker, and her job is going to be helping us understand how we build insurance products that help bridge the gap between the insurance and financing industries. Some of the very almost relatively plain vanilla examples, Mark, could be surety. The opportunity to deploy surety insurance inside M&A deals to provide deferred consideration solutions or whatever it might be is real. The opportunity to deploy surety bonds in areas like cash confirmation bonds in public market takeovers is real. They've been done in the past, but not industrialized. And I remember doing a deal where a surety bond was used in a way which really unlocked an M&A deal. And the buyer of that deal thought it was the most exciting financial technology, he called it, he'd seen in ages. It was just a surety bond. But surety bonds have their place in our world.
Yeah, we always think of it in construction, and that's
exactly.
it. Yeah.
And we haven't taken an existing insurance product, an instrument, and thought, how can it be deployed in this different environment? I think that's a huge opportunity.
So there's almost like a completion bond for a deal to make sure that we know this deal can definitely happen because you will have the finance.
Yeah, exactly right. So in a public markets environment, the company launches a public company takeover. They have to prove the day they launch the offer that they have the funds to complete.
Yes.
You can do that with a surety bond, right? But no one's done that. Well, It's been done once, but no one's industrialized
We should be doing that more. Yes, absolutely. What would the employee benefits angle be?
So employee benefits is a lot more around, well, again, you can break that down into, it's a big bucket. One of the trends we're seeing, particularly in the private equity world, obviously less than the corporate world, is PE funds, particularly as they hold on to assets longer, are having to sweat the assets operationally a lot harder. Part of that is looking across the portfolio that they own. If they own 20, 30, 50, 100 different companies, all of which buy both P&C insurance and employee benefits insurance, how are we really putting a procurement strategy, a risk financing strategy in place across all of those assets, which A, delivers what we need, and B, delivers some value? And I can tell you that one of the biggest private equity funds in the world, when they added up the amount of money they were spending on private medical insurance across their portfolio, it's an extraordinary amount of money. And private medical, as many people will know, has got serious inflation issues in it, right? I mean, it's double-digit inflation annually, and that is a cost which is popping up on CFOs' P&Ls in portfolio companies of PE funds as a real challenge every year. And if there's a way of mitigating some of that cost by taking it as a whole rather than individually, we're seeing much more of that.
So much more sort of aggregating, consolidating things and just hoping you can get a bulk discount, etc.
Exactly right. But then you go to the other end of it, single product stuff. Look, key man insurance still plays a role in certain M&A deals. Banks, coming back to banks, if they believe that a key risk issue is an individual, they will want to see some key man insurance in place because that allows them to financially de-risk the M&A deal in a way that they can make it bankable and financing. So I come back to my point that any M&A deal you look at or any bank-backed operation you look at, somewhere in there, and I think what we don't do as an industry is understand what role our solutions and products are playing. When we get a call saying, can you do some key man insurance? Yes, we can do some key man insurance. Do we understand why that key man insurance is being procured? Possibly not.
You want to put the whole thing into the context.
As I come back to, M&A is a situation, not a solution. And yet, if you go and ask 1,000 people, even those that work in the M&A insurance industry, insurance M&A business, how does our industry help people do M&A deals? The ones that don't work in the M&A business, you'll get a lot of not really sure. The ones that do work in our business will go, oh, W&I insurance. We're in danger as an industry of getting put in a very single product box rather than being able to articulate the value we bring to the whole.
There are 7 or 8 products they could be buying.
At least, right?
Yeah.
At least.
And blended together, it could be something really powerful. What about AI? We mentioned AI right at the beginning. I think we're sitting in 2026. We can't not talk about it. But sitting from the outside, this sounds like the most ideal application for AI, because we're talking about vast amounts of data, these data rooms and things. You get access there, and just letting an AI loose on all those numbers and all that stuff. It sounds to me like it would be a really, really great use of AI. Is that the case?
I think you're absolutely spot on. I mean, look, I'm old enough to remember when data rooms weren't digital virtual data rooms. It was a physical room with a load of paper in, and you weren't even allowed to take a laptop in to type stuff. You had to handwrite the notes. And so I am absolutely a believer in the opportunity for AI in this space. Again, as you say, you have now digitally disclosed information in a structured manner in a data room. And again, I'm not a tech guy, but if you can't deploy a large language model to sift through that information in a super efficient way, then we're all missing something. So yes, look, it's coming. I think there are lots of us in the industry looking at how we use it in both a broking and underwriting sense. And the first ones who crack it and really build something which is viable will have their nose ahead of the game.
Imagine it's going to say, I've flagged up these 47 different anomalies that you should look at. Can you just double check this in my due diligence? Or
every time you have a library of, so all the lawyers have their own preferred language for different types of warranties in an SPA. So you build a library that says this is XYZ's language, this is ABC's language, and how do we respond to that in our policy terms? The opportunities are phenomenal, but like everything, there'll be a race to who can get there first, and it'll be interesting where that comes out.
Optimistic that there's lots of applications.
Hugely optimistic. We're already piloting it in our business, both in the placing business of the insurance M&A policies and in the diligence and advisory business. We're piloting it right now.
Putting your broker hat fully back on again, we talked a bit about structuring. What's the relationship with reinsurance and how's that developing? And if I look at another novel class like cyber, it's really fascinating when you watch a class mature. To start with, the reinsurance relationships very often just pure quota share because it makes most sense. And then as people get more and more sophisticated and understand event definitions and what cat risk might look like, for example, that relationship changes. Again, so it's illustrative of the way the sophistication within that class itself has gone up. How is it at the moment?
I think that's a great question. Look, there are teams we have a great team on the Gallagher side who spend their lives doing nothing but supporting both MGAs in the capacity management and capacity raising in this class, and also putting together increasingly sophisticated treaties. There are now standalone treaties starting to be put in place for these classes.
I thought that once you've got that much income, there must be.
And what's also interesting is you're starting to see some composite carriers, corporate insurers, who are looking to enter this class, who traditionally, if they were entering this class, was doing so via MGAs, now making a decision to come in on a direct basis, which frankly I welcome and applaud and would encourage more to do, as much as we love our MGA partners, obviously. But the way that that's being done is quite interesting. Some of them have got very, very interesting treaties in place, which are meaning that their retentions are very low, but they feel they need to play in this class of insurance as a brand because, hang on a minute, I'm insuring thousands of these corporate clients in the UK, but the one thing I haven't been able to deliver to them is a branded solution for when they do something really interesting like an M&A deal. I feel I need to be in this space, but I feel I need to tread into this space in a risk-managed way. And they're doing so in a really quite creative way from a treaty point of view.
And is there any cat risk? And I suppose, is there systemic risk as well? Because obviously, I suppose tax is a system, isn't it? We know that there are tax systems. So I suppose there must be systemic risk.
I think hypothetically there is.
Yeah.
I think we've arguably seen a potential example of that recently. There was a lot of noise around Indian tax insurance over the last few months with a ruling in India about tax structures that were being very widely utilized in Indian transactions and very widely insured in Indian transactions. Now, there's been some clarification about this is a go-forward position only. We're not going to retrospectively reopen the past and all that sort of good reassuring stuff. But the point is that, frankly, is a potential systemic risk. The same goes in other known risk areas. And it probably, Mark, in a constructive way, comes back to your point about the banks. If the banks are looking to lay certain risks off, are worried about certain risks, and they are looking to lay them off because of their own risk appetite, then we've got to make sure that we're not taking them into the insurance market in a way that does create a systemic risk. And it comes back to that point I made about we need to make sure we've got a sustainable market. This has to be a market that's around for decades to come in terms of delivering value in M&A deals. We've got to make sure, therefore, people understand the distinct subsets of this area. We don't just throw the baby out with the bathwater. We don't just talk about it in a generic sense. There are very substantial and material differences between known risk solutions, unknown risk solutions, deal sizes, jurisdictions, etc., etc. There's some real nuances in here.
Because there's been a lot of correlation, but also there's a lot of diversification as well. The no two tax minimization schemes are the same, aren't they, ever?
Yeah. And if you look at some of them very successful MGAs in the space, of which there are many, the way that they manage their portfolio is really interesting, both geographically and product-wise, and also by deal segment-wise. There's some very smart markets that are very focused on writing excess only. The market is maturing and people are starting to find their sweet spots and where they want to focus. But I think ultimately this is a product which the better we can articulate the value of it, and this is the wonderful thing about it, because it's in a M&A deal where the motivations to buy can be so clearly articulated, you can articulate the value of this product and therefore you can make sure that it becomes sustainable. Again, it comes back to my point about if you choose the sectors you write in, the geographies you write in, the deal segments you write in, and you understand them deeply, then you'll be managing yourself appropriately.
Alistair, when I started this podcast, I thought this is exactly the sort of thing I want to be doing. Obviously, we interview some big CEOs and other things, but sometimes the podcast medium gives us this ability to really talk to somebody. And we start with this very small snowball, and by the end of it, hopefully we've brought everyone listening along with us and to feel that we all know a lot more about M&A insurance, transaction insurance, tax, liability, contingent insurance than we did before. And I've really enjoyed talking to you. It's fairly obvious. I've really been enjoying this conversation because I feel like I'm learning a ton as I go along. And so I hope everyone else listening also agrees with me when you've been able to follow how it's all gone. I've just really enjoyed talking to you. Thanks so much.
Well, listen, Mark, thank you. I mean, you can hear from me, I love this sector. I'm passionate about it. I have made a deliberate decision to build my career in insurance in this part of the world, and we're scratching the surface in terms of the opportunity.
I absolutely agree with you. Thanks a lot.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.